Hello everybody, this is Reg, and welcome to Give Yourself Enough Credit. Today's topic is going to be mortgages. You ask yourself, what's a mortgage? Well, I'll tell you. The real estate definition is that a mortgage is a debt instrument secured by the collateral of specified real estate property that the borrower is allowed to pay back with a specified set of payments. In layman's terms, it's a home loan. As you can see here, there's 8 different types. And I'm just going to go simplistically down the line as far as what they are. A 30-year rate, fixed rate mortgage is usually your most popular one. And it's usually one that your interest rate never changes. Your monthly payments are typically lower. And the major advantage for this type of loan is that the person has the flexibility to pay it off faster. You got the 15-year loan, which is basically has a lot of the same characteristics as the 30-year loan. The only real difference is your interest rates are typically lower, but your monthly payments are usually higher. And this is best for people who are that refinance, or you have home buyers who want to build equity and they want to pay this loan off in a shorter period of time. But the benefits of it is that the interest really stays the same, and generally your interest payments are less. The next one is an adjustable rate mortgage, or if you hear the term ARM, this is what it refers to. This is a home loan where the initial rate stays static for a period of time and then it adjusts after that time. It usually can be locked in for either 1, 5, 7, or 10 years. This is usually best for home buyers who don't plan on having a mortgage for a long period of time or believe that interest rates will actually go lower after that time. The next one is the FHA mortgage. This is one that's backed by the Federal Housing Administration. It's backed by the government and designed to help borrowers more modest means to buy a home. It allows payments as low as 3.5%, and it's usually geared for credit scores lower than 500, as low as 500. But with that, mortgage insurance premium payments are typically required, and it's best for borrowers with lower credit scores, and a down payment has to be no lower than 20%. Next is the VA mortgage. VA loans are backed by the Department of Veterans Affairs. These are generally available to military service members or veterans. No down payment is usually required, but usually an upfront VA funding fee is required. And there are generally no mortgage insurances associated with these type of loans. These are people this is best for military qualified borrowers who appreciate low interest and no payment down minimum. The next one is your USDA mortgage. These are your home loans that are usually backed by the United States Department of Agriculture. Usually no down payment is required for these type of loans. Home improvement loans and grants are usually available under these type of loans. But keep in mind, income limits and property value caps apply. This is usually best for low income qualified buyers in rural and suburban areas who want a low or zero down payment. Your jumbo mortgage or your jumbo loan. This is a mortgage above a certain dollar amount, and it varies by county and it adjusts periodically. It can have a fixed rate, it can have an adjustable rate. This is a loan that typically requires a credit score of 700 or higher. And this is usually best for buyers of expensive homes or owners who want to refinance a jumbo size home. And the last one I want to share with you is your interest only mortgage. This requires payment only on the lender's interest charge. The loan balance is not reduced during the interest only payment. This is appropriate for buyers who are disciplined enough to make periodic principal payments. Useful to home buyers who don't expect to remain in a home very long. And they have to show substantial assets and a proven ability to pay. So this is generally who this is geared toward. These are best for borrowers with high cash flow, a rising income, large cash savings, and income that varies from month to month, and for those who receive large annual bonuses that can pay down the principal. From state to state, those laws are going to vary. But these are like the top 8 that generally most people go into. Okay? How's this tied to credit? Well, nearly all of these are linked to a credit score. Now, this info segment is designed to help the buyer get an idea of what they're looking for, and it's going to help the seller because if one person is better educated on what type of mortgage they want, then it's going to get them one step closer to being able to go after their dream eventually. Okay? This is what I like for you to do. I would like for you to like if you do, dislike if you don't, put comments in there, share it with anybody that you want. This lets me know that we have new editions coming. All right? This is Reg, and you need to give yourself enough credit. I love you guys. Take care of yourself.